and I will be taking up Unit 5 of the subject Stock Market Operations. In this unit, we will be covering 3 sections. The first section is on special investment strategies in shares. The second section covers new issues on how to make money. The third section includes miscellaneous issues in stock markets. The first section, in this, we'll study special strategies for investment in shares. Investment strategy. They guide investing decisions according to a certain set of criteria or according to a theme. Investing strategies can provide discipline and a disciplined method to your investment activities. Investment strategies have strengths and weaknesses which allow you to evaluate and compare them. Major investment strategies include: first, buy and hold investment; second, growth investment; third, momentum investing; fifth, value investing; and the last, small cap investing. Then dividend investing, then ESG investing, factor investing, passive investing, core or satellite approach, long or short strategies, multi-asset investing. Then we'll study all of these in details. The first is the buy and hold investing. This is the simplest long-term investment strategy where you simply buy the stock and you hold it for a certain period. Individual stocks are simply bought and held indefinitely. How well a buy and hold portfolio performs will obviously depend on the companies that are held. So one has to make sure that the company has strong fundamentals for which the buy and hold investing strategy is considered. Next is growth investing. Investing in growth stocks is also exciting, and you get to learn about the companies that are innovating and creating the future. However, growth investing should be approached with caution. Growth stocks typically have the highest valuations in the market. They need to live up to the market's expectations to justify their valuations, or the stock price will correct, often very dramatically. So these growth stocks are highly valuable. They can be stocks of public sector companies or of the government company. It depends on how you make the choice. Next is momentum investing. Momentum investing is also similar to growth investing, but it considers the stock's price momentum rather than earnings or revenue growth. Evidence suggests that top performing stocks during a given period have a high probability of outperforming during subsequent periods. So momentum investing is price momentum based. Then comes value investing. Value investors buy stocks trading at low or below their intrinsic or fair value. The fair value is the true value of the stock. This provides a margin of safety when the unexpected happens. The lower the valuation is when a stock is purchased, the less the company has to earn to generate decent return in the future. So when an undervalued stock is bought, it has high chances that it will move up after a certain period of time. Small cap investing. There are 2 advantages to focusing on smaller companies. Firstly, it is easier for a smaller company to grow in profits. Doubling revenue from a base level of 100 million is a lot easier than it is from a base level of 10 billion. Secondly, Smaller companies are more likely to be overlooked by investors and therefore trading at a high discount. As the company grows, other investors take notice and the discount will narrow. This can provide an additional return if you are an early investor. Dividend investing. The objective of dividend investing, also known as income investing or yield investing, is to generate an income stream. Stocks with high dividend yields are usually very profitable but have relatively low growth rates. If dividends are reinvested, a yield portfolio can experience substantial capital growth too. Companies that pay dividends are typically quite profitable and therefore also defensive during recession. ESG investing. ESG investing considers the effect of environmental, social and governance factors on the long-term value of the company. The rationale is that companies that take governance and their environment seriously are more likely to succeed. ESG investing is similar to SRI, socially responsible investing, impact investing, and ethical investment strategies. However, these approaches seek to restrict the way capital is used. Factor investing. Factor investing is an evidence-based approach to selecting stocks. Investment factors are characteristics of stocks that have been proven to outperform over long periods. Many of the most commonly used factors are those covered above: value, growth, market value, and momentum. Other commonly cited factors include volatility and quality. Passive investing. Passive investing or indexing is a variation of buy and hold investing. However, investments are made in indices rather than individual stocks. There are several advantages to this approach. Firstly, investing in market cap weighted indices means you will be invested in the fastest growing large cap stocks in a stock market. Core satellite approach. The core satellite approach to investing combines passive and active investing. A core portfolio of exchange-traded funds is held along with a handful of actively managed investments. This allows a fund manager or investor to take advantage of occasional opportunities that will be missed by index funds. Long-short strategies. Short selling is one of the only ways to capture downside returns. This doesn't allow one to profit from stock market crash. Combining long and short positions reduces market risk in a portfolio. Returns can be generated from the relative performance of two instruments regardless of the direction they are moving. Multi-asset investing. Stocks typically generate the highest returns over the long term. However, they are also the most volatile asset class. Superior risk-adjusted returns can be generated by combining several asset classes. The more asset classes there are in an investment portfolio, the lower the volatility and the portfolio risk will be. A very diversified portfolio may include stocks, bonds, cash, commodities, real estate, hedge funds, and private equity funds. Diversification can be increased further by spreading the stock portfolio across the several of the investing strategies listed above. Next part is new issues or how to make money. There are 5 different ways for the investors to make money from an equity investment. The first is dividend. As an owner, the investor is entitled to a share in the profits of the company. If the company chooses to distribute these profits through dividend, the investor earns a specific amount for every share he owns. Capital gains. An increase in the market price of the stock benefits the investors since he or she can make profit from the sale of the holdings. Over the course of years, an investor may make more than 50 times of what he has invested. Buyback. The company may declare to buy shares from its shareholder at a price higher than the market rate. Although not every investor wishes to sell shares, one can make an extra profit through the buyback window. Rights issue. On the issue of new shares, the company may give a discount to its existing shareholders. The investor can make profits by purchasing shares at a discounted price and selling them at a higher market price. Bonus issue. If a company is performing exceptionally well, it might give free shares to its shareholders. These additional shares soon start trading at market prices, giving an excellent opportunity to the shareholders to make profits. The last aspect of this unit is miscellaneous issues in stock market. Factors that affect the Indian stock market are: first, government policies. Economy and businesses are largely affected by the government policies. The government has to implement new policies in regard to the economic condition of the country. Any new change in policy can be profitable for the economy or tighten the grip around. This creates a possibility of the stock market being affected due to any change or introduction of the new policy by the government. The government policy can be monetary policy or fiscal policy. Exchange rates. The exchange rates of the Indian rupee keep fluctuating vis-a-vis other currencies. When the rupee hardens in respect to other currencies, it causes Indian goods to become expensive in foreign markets. Companies that are highly affected are the ones involved in the overseas operation. Interest rate and inflation. Whenever the interest rate goes up, banks raise the lending rates, which increases the cost for corporates and individuals alike. The rising cost will tend to create an impact on the profit levels of the business, affecting the stock prices of the company. Inflation is a surge in the pricing of goods and services over a period of time. High inflation discourages investment and long-term economic growth. The listed companies in the stock market may postpone their investment and halt production, leading to negative economic growth. The fall in the value of money could also lead to a fall in the value of savings. Foreign institutional investors and domestic institutional investors. FIIs and DIIs activities highly impact the stock market. As they have a prominent role in the stocks of the company, their entry and exit will create a huge impact on the equity market and will influence the stock markets. Politics. Factors like election, budget, government intervention, stability, and other factors have a huge impact on the economy and the financial markets. The political events and budget announcements create tremendous level of volatility in the market, influencing the stock market deeply. Natural disasters. Natural disasters hamper the lives and the market equally. It impacts the company's performance and the capacity of people to spend the money. This will lead to lower levels of consumption, lower sales and revenues, ultimately highlighting the company's stock performance. Gold prices and bonds. There is no established theory that expresses the relationship between stock price and gold and bonds. Usually, stocks are considered a risky investment, whereas gold and bonds are considered as a safe investment havens. So, at the time of any major crisis in the economy, investors prefer to invest in safe instruments. As a result, gold and bond prices increase while the stock price tumbles.